All right, Trent, I'm excited to dive in with you and learn more about what you're working on and what what brings you to the show. Do you
Yeah,
want
thanks.
to?
Thanks for having me on.
Yeah,
I'm sorry, I didn't mean to talk over you there. My bad.
no, no, not at all. I love that you're coming in from sunny South Dakota. Uh, you mentioned pre-show that there's a lot of payment companies in South Dakota. Is there a origin to that story, or is it just happenstance?
There really is. I always use the phrase "all roads lead back to Citibank." So in the mid '80s, when interest rates were very very high, and I'll give you the condensed version of the story. Citibank was looking for a place to move out of New York because as rates on deposits increased, they were capped at a certain ceiling on loans, and of course that shrinks net interest margin for a bank, which of course is a critical metric. And so Citibank had reached out to South Dakota, who was at the time looking to get rid of its usury rate, the cap on interest, so thus would allow, net interest margin to float. And timed it right, and Citibank moved out to South Dakota in the mid '80s. So home base for Citi is still in Sioux Falls, and then sort of out from that sprung sort of a whole ecosystem of payments. And so you can, two or three steps removed, usually you'll be able to find a road back to Citibank. But that sprouted out other credit card issuers, which sprouted out prepaid issuers, which now sprouted out fintech-related payments issuers. So it really incubated this area of the country for payments.
So regulation, if you were to boil it down, there was incentives that South Dakota put into place that attracted businesses.
Yeah, and I think the primary incentive was getting rid of the cap on loan rates, and so that if market was dictating a certain rate on a deposit, Citibank didn't have an artificial or legislatively determined cap on what they could charge for a loan, and so things were able to sort of float at sort of the market-driven rates, and that was attractive certainly to a large credit card issuer like Citi, just like it is for most any company today that's in financial services.
What is that? It's a cap on a loan rate. So is it that banks can't lend out money any lower or higher than the government dictates?
Not quite. There's a certain number of states, I would say, man, I don't hold me to this, but I'm going to say roughly half, maybe a few more, that puts a cap on what a financial institution could charge a consumer or a business or whatever the type of price as a rate on a loan. It's called usury. And there are a number of states like South Dakota, Delaware, Utah, Georgia, there's more, that said, look, we'll get rid of that and get rid of that cap, let the market dictate the proper rates. And so that's popular with nationwide issuers of products like credit cards. And then long established law is if you're based in a state that doesn't have a cap on interest rates, you can actually charge that. That drives or that governs the rules no matter where the borrower is. And so if bank is located in South Dakota and borrower is located in Connecticut, Connecticut may have a usury law that says you can't charge more than 18% for a credit card, for example. But because the bank is located in South Dakota law governs. It's called preemption. And so those things work really well for financial institutions that are based or that have a primary source of revenue and business coming from nationwide issuing, because that way that's one set of rules across all 50 states.
Wow, that's pretty fascinating. And that's the way it operates today. So if I open up an account with, say, Citibank, for instance, if they're headquartered in South Dakota, is the implication for the consumer that they can, or we, in the case of, say, I open a bank account, I would imagine I can get a bank account regardless of who I am. It's just going to be really, really high interest rates. And then if I'm a high risk person in a state that regulates that or caps that interest rate, the implication would be the bank would reject me, the consumer. They would just say, you're too high risk. We can't go above this threshold.
Right. So certainly this opens up, there's a lot of schools of thought around, if usury's net positive or net negative. But certainly if there's not a cap on interest rates, lenders can delve a little deeper into more tarnished credit histories or lack of credit histories because they have some pricing flexibility that just wouldn't be there if they were based in a state that had very strict usury laws.
Oh boy, it seems like I can't see this. I mean, maybe there's implications of this that I can't imagine, but if you don't allow if you don't allow a lender to lend high interest money, then you're blocking people who probably need it the most. And their options are, hey, I just don't have a bank account. I mean, it's way better to have high interest credit than to have no option at all. I don't know what would be the argument.
I share that opinion.
Yeah.
I share that opinion. I think there are certainly people that don't share that opinion, that they think that there's a point in which interest becomes so high that you're you're actually providing a disservice to the consumer. I don't necessarily subscribe to that, but there certainly is a very vocal subset of the population that feels like usury is an important law to have in place, and there should be limits on lending. Now, today's rate environment is interesting because you aren't faced with having to pay high rates of interest on your deposits, and so you don't have that pricing compression that was really forcing Citibank to look for alternatives back in the mid-'80s, because the interest rates right now, as we all know, are historically, at all-time lows, almost couldn't get lower. And so that same sort of financial incentive that drove Citibank to South Dakota probably isn't there, and there's plenty of net interest margin now that wasn't there before. So, the economics have changed a little bit, and certainly the economy is different now than it was back then.
Yeah, it's almost like it's not as relevant today because no one's hitting that high interest rate cap.
Yeah, I mean, I think certainly banks have a little bit. I think certainly they are in a little different situation than they were before because they aren't having to pay out high rates on deposits right now. And so that does open up a little flexibility that may not have been there before, because reality is you just can't absorb losses if your margin between what you pay on deposits and what you charge for loans, you just can't absorb much for losses if that margin is very narrow, whereas if it's wider, you can usually absorb a little bit more loss, and so that opens up the credit market a little bit for the average consumer.
Interesting. You sound very knowledgeable about
And by
this.
the way,
Yeah.
I'm drastically oversimplifying.
Oh yeah, of course. But I appreciate that because that's the way I can at least understand it conceptually. And so tell me about you. So you're now running a company, Central Payments. You've been in South Dakota, I imagine, for a while. What's Central Payments? What are you trying to do or doing in the world?
Sure. So my background, I've been in financial services my whole career, going on 29 years now, in various forms of financial services. I got my start actually as a regulator at the FDIC. I was working for the federal government right out of college. A great experience as a bank examiner, going bank to bank to bank to bank, and seeing different scenarios and different business models and all those sorts of things. So a wonderful experience early in my career. Moved over to the banker side of things, but really focusing around all forms of payments, especially consumer payments. At that time, very much card driven, but as we know today, a little less card activity and more digital money more than anything else, or virtual, if you want to call it that. We started Central Payments about 7 years ago. A small bank in Kansas City called Central Bank of Kansas City reached out to me and said, as we struggle coming out of the late 2000s with the economic crisis, thinking about how the bank is going to continue to grow, it was difficult for a small bank. And so they saw this emerging fintech wave and the way in which, there was an opportunity to acquire deposits via payment products and financial technology companies, et cetera. And so the bank, rather than sort of plant branches all over Kansas City, said, I think we're going to focus on the infrastructure of payments and really look to try to ride this emerging fintech wave, which, at the time, 7 years ago, was just starting to catch traction. And so, we timed it very fortuitously, because as we came up in financial technology, so did the rest of the industry. So, we didn't have to reinvent business models. We were able to think about the way in which a bank could be a technology-forward institution, but but without having to sort of re-engineer anything. So we built it technology first, and that's worked out really well for us. And so today, Central Payments manages payments programs with fintechs and embedded finance companies, really from all over the world on behalf of Central Bank of Kansas City.
Oh, interesting. And is it exclusive to Kansas City?
Yes, so we're wholly owned by the bank, and so really everything we do has a bank component in it. We manage, a lot of relationships on behalf of the bank with partners that need a payment product for a whole myriad of reasons.
So will you sell to other banks, or is it specifically building tools and products for central banks?
Most of our partners are non-banks, primarily because with everything going digital, everything being online, so mobile centric, it's really non-banks that have seen the most growth in recent years in fintech. And so we look at our business, we look at our sales verticals, really, there's really two of them for us. One is what I would call an early stage fintech company that's building great user experience, great products, usually very mobile centric, and they need a bank to connect into the payments ecosystem. And so they need a bank partner, and they come to us because we speak technology with them. They find it easier to work with a technology forward bank, which is not something that historically, when you think of a bank, you don't really think of cutting edge technology in many cases. And so that's been attractive to that vertical. And then I think the other vertical are really very big brands that you probably know that you don't think of as a financial services company, but they need a financial product for a specific reason embedded in their overall product offering. And so, really simple example, you could buy a set of tires from a company and they want to rebate you for that, and they need a payment product to push that rebate back to you. So they issue a rebate card to you. But in the end, they're a tire company, but they need a financial product for the overall consumer proposition. And so they look to us, again, sort of a one-stop shop, technology plus a bank, all rolled into one, easier to market, faster to market, et cetera.
I dig it. And this opportunity came across your plate 7 years ago. Was it? You weren't working at the government at the time. You were in the private sector for many years.
No, I was at the at that time. I'd been out of the FDIC. It was only the first 9 years or so of my career. The rest of it's all been around the banking side of consumer payments. And the bank reached out to me and said, "Hey, we want to try this." And I said, "Okay." But I said, "Look, we've got to do it in Sioux Falls." And, they kind of said, "What? Sioux where?" But, like I was saying in the pre-show, we're not a mecca for many things around here. I mean, outdoor recreational hunting, fishing, and payment cards. But that's the reality of it. And again, it goes back to the story around sort of all things grew out of Citibank or sprouted out of Citibank. And so when we decided when we were going to build this out, I said, we got to do it up here. We can find great talent, very, very experienced talent right here in our local marketplace. And I think that's why you see lots of payment card issuers here.
Do you know offhand what the population is?
Yeah, Sioux Falls is going to be right at about 200,000.
That's pretty small. It's a pretty small
town.
Yeah.
Interestingly, the statistic I heard is 75% of all card products are issued out of Sioux Falls, especially prepaid cards. And so they're issued by a bank that has operations in Sioux Falls. And I think I heard one time 1 in 16 people in Sioux Falls work in financial services.
Wow.
So it certainly is a big part of our local economy here.
Interesting. I'm curious to ask you about your first 9 years of experience of your career, in particular, and how it fits in with the story of what we're doing today. Today, we have very, very low interest rates. We have crypto that's come on the scene, which our regulators are working hard to figure out the proper way to regulate crypto. The existing banking infrastructure is moving much more digital, and so there's banking as a service coming on in a huge way. Local banks and credit unions are dissolving quickly. The idea of a local place where you have to go and do your checking or banking is kind of, it's just quickly becoming a relic of the past. What other trends am I forgetting here? And how do you see the role of government in payments previously, and then in particular how it should be today?
Yeah, I mean, I think you can probably go back to about any period in modern history and always point to the fact that you viewed the government as being one step behind innovation. And I think financial services is really no exception. All the things you just said, things that are becoming more and more commonplace for all of us, the government is still trying to figure out how they want to regulate that, or if they want to regulate that. And meanwhile, innovation is taking off and is on the sort of proverbial hockey stick of growth. I think, to go back to your question, I think that the government is always going to look to see how the market is reacting to innovation and trying to figure out what the right avenue is, or what the right role for the government to play. In some cases, they'll look back and say innovation, really took off, but then we saw, bad actors, questionable activities going on, and we had to jump in because the market wasn't going to sort of protect consumers by itself. Let's just say that would be the view of the government. And so I think as they're looking at crypto, they're trying to understand, is it going to be this divergent in terms of, you think about all forms of crypto, and how do they begin to regulate everything, stable coins and NFT and all those sorts of things? Or is there going to be a prevailing model that sort of settles in and starts to take traction? And then is that the right time? I don't think they want to necessarily have to, the last thing they want to do is see a very divergent business model and then trying to regulate that much diversity within the model, if that makes any sense.
Yeah. They
They probably would like to see one thing take a little traction and then say, look, we're going to focus our efforts there. I don't know if that's going to happen as it relates to crypto. It is incredibly decentralized. That's the whole theme, right? That's the purpose. It's decentralized. And so you're talking about a centralized government entity trying to regulate something intrinsically decentralized. It's a big task.
Yeah.
It's a very big task.
Yeah, it's especially tricky when there's not one person behind the project. If it's an open source or decentralized organization, you can't go anywhere. It's not a U.S. company. There's no one to threaten. I mean, ultimately, the government enforces every financial policy with a gun. The threat of putting you, coming to your house and locking you up, putting you in jail. That's what it boils down to. As an entrepreneur, when you're thinking about your spectrum of risk tolerance when you're building a payments company, you're like, well, I don't want to be like that guy, having terrorist money going through your platform or whatever nefarious actors are on your platform. So I hear you. It's really difficult for a government to come in. I wonder if do you have a view on how they're doing? Not to give them a score like an ABC, but if you feel like are we conceptually from the highest level, are we as in society and the government, is it effective? I mean, is it doing a good job? Is it useful?
Look, I think they always want to. I think the government has clear aspirations to look out for the consumer, right? Mm-hmm. And I think that's a proper role, right? I have no issues with that whatsoever. I'm a little worried that a window was missed when it comes to digital currency. I'm worried that, a year and a half ago, when I think they probably thought maybe it'll just go away, it actually didn't. And then, of course, it's rebounded, and it's the last 6 months has just been bananas. And so now I think there probably is a lot of anxiety around, okay, that was a window when it was still relatively narrow in terms of what it was trying to do, a smaller number of providers, but now it's just exploded. And, I'm sure they're wrestling with what they want to regulate at the source, as you would if you are a regulator. So now how do you regulate at the source when arguably there isn't a source? And I don't know. I mean, it's going to be fascinating to watch. I think, like I said, I think all of us 2 years ago said, well, I'm not sure it's going to hang on. I'm not sure it's going to keep its momentum. But it's proven us wrong for sure, this year especially.
Yeah.
So I don't have as much as I'd like to say this is how they should do it, I feel I'm envious of I'll put it this way, I'm very happy that I don't have to be the one to try to figure out how to find the balance between regulation without, negatively impacting the growth of something that's very exciting, frankly. It's something that we haven't seen, we haven't seen.
Yeah.
That's the reality of it. So there's a pivot point here. There's a fork here that they're going to have to decide the way they're going to go in terms of regulation, and then trying to understand, if we do that, what is the impact on this economy? And it's going to be a very, very difficult balancing act.
Yeah. I tend to view it as the U.S. government had at one point an enormous control over the world economy through the financial arm. The U.S. dollar was used in so many places in the Western world and even in the East that a policy here ripples out everywhere. But when the U.S. dollar becomes not a part of the equation anymore, now we're talking about cryptocurrencies, which are totally separate, and the people building them are in so many different countries. There's no one centralized place you can go to. It makes it almost changes the goalpost, right? It's like the government on some level is incentivized to keep the power within the U.S. dollar, because if it doesn't, then it loses control. And I almost think the balancing act, or the dance that's going on right now, are the people who are in FinCEN and the SEC and the Federal Reserve, they're hanging out, having lunch, and they're saying, hey, we are no longer able to control the currency of the world. And are we going to let that happen? Are we going to try to fight? Is the attitude internally, no, we've got to fight to keep control. We can't let crypto take hold, or just let it run its course? Because on some level, I view it as the more we fight this transition to crypto, the worse off American citizens are, because it makes it less appealing to build in this country, less appealing to be a consumer. There's times I go to a crypto site and I can't do something because it says, oh, you're blocked because you live in the United States. You can't, apparently, I don't know what this rule is, but you can't get paid in tokens from a lending company like Nexo and Celsius can't pay out. And I don't know what the specific rule is that they're nervous about, but there's something there that the U.S. at a minimum is unclear about. And being clear is better.
And so if you think about that, that's just a lot of flows. That's a lot of currency flow that's going around the United States. And so clearly there's a consumer demand to be able to transact in various forms of crypto. The government has to think about that. They have to think about, to your point, not having an entire monetary system that's going around the United States. Not only is the influence not there like it has, you're not even part of it anymore. So do you really want to be on the outside looking in? I don't think they do. I mean, I think they recognize these things, but I don't think they figured out what the right avenue is yet.
Yeah.
It's a daunting task.
Yeah, and I wonder what the pressure is for them to figure it out. Ultimately, doesn't it boil down to people who are voting for elected leaders pressuring them to make some policy? Hey, I got ripped off on crypto. These people are stealing money, or they're using money to do sex trafficking, or it seems to boil down to fraud, like I tricked you out of your money. Something related to sex, or something related to terrorism. Like, those seem to be the big buckets that people get really heated over, rightfully so. No one wants to fall victim to any of those three categories. But if those aren't happening in large, if it's just a rounding error, the chase for perfection sometimes, the chase to get to 100% safety is sometimes coming at a huge cost. So I view it as long as the marketplace is self-regulating, in terms of people are calling out the companies that are acting fraudulently, there's good transparency of data, which to me, it seems like there is. I don't hear a lot of cases of people coming in and being ripped off systemically, in terms of like they're capturing a big part of the market and ripping it off. And anyway, what is the government going to do about that? Not very clear to me.
And I think the particularly difficult challenge is, when they do decide where they're going to draw that line, right? And just let's use your example that you think it might be fractions of a percentage point of fraud or nefarious activity. What you have to be very, very cognizant of is they may not draw that line at that fractional point you just described. They draw a line much more draconian that then has an inverse effect on, the innovation that's taking place right now. And I think they have good intentions. I think they don't want to do that, but it is a very difficult line to draw. And then it comes down to this question, and I think it's just, different philosophies about should you try to protect the 0.5% that may have had a negative experience on an individual isolated basis without any indication of any systemic problem. And I think there are people that say, yes, absolutely, that is fair game for regulation. And others would say, no, if you look at it on a whole, the self-regulated approach is working. You're never going to have zero of the three activities you just described. You're never going to have a zero rate of that taking place. But by and large, it's working. And I think there's just two schools of thought on whether or not the government has a role to play in the individual consumer experience. And I think as crypto goes more and more mainstream, and you probably have less and less and less sophisticated consumers making big bets more than they should on that, then I think the cries are going to get louder. And then you worry about wherever that line is drawn that I mentioned, a few minutes ago, being a bit draconian. And we're just going to have to watch and communicate and educate, I think, more than anything else.
Yeah. Luckily, I do feel like there are a lot of smart people working in crypto that think a lot about these things. So because there's so much attention and smart people in the space, I have a lot of faith that we'll figure it out collectively. When it boils down to people who are not in crypto at all, who are voting for politicians to put pressure on crypto companies, I think that's the vulnerability in the structure of how we make policy. I should add that I think the tax part of it is probably a fourth pillar, that if there's no oversight governmentally, then the temptation to at least trim tax, I only made this much instead of this much, and they have some in this wallet. That is, if that becomes widespread, if 80% of people do only report half of what they make in crypto, then that puts an enormous lopsided burden on people in the fiat currency, and that's not a sustainable system, because then people are going to revolt. Anyone who doesn't own Bitcoin there's going to be riots. So yeah, I think that's a good way to think about the qualifiers there. How do you view the intersection between the traditional banking payment card industry, which is advancing in its own right? There's a lot of companies in the space. There's a lot of advancement in technology in banking as a service, and neobanks online that are raising lots of money, and there's a lot of smart people working on that side of the equation too. There very much seems to be a line drawn in the sand between whether you're playing in the fiat world and traditional payment world, or whether you're in crypto. Do you see a directional intersection between these at some point, or?
I do. I think my general view of it is that if you're in the payment space like we are, it behooves you to provide access to every possible payment rail that's available. And that could be everything from a paper check to crypto to transmission, to Visa, MasterCard, Discover, et cetera, et cetera, et cetera. But at this point, the options available to consumers are so vast. So I tend to believe that banks should recognize they probably aren't going to be able to keep up from a product standpoint in financial products, if you think about that today, and say, look, I need to take more of a utility approach to this thing and say, I'm going to focus on providing dependable access to the payment system, and let you decide and you make the choices on what those appliances are or your desired way of transacting is. And so the analogy, and my coworkers and my staff tell me I probably overuse this, but if you think of the end device that consumer is using as a bit like an appliance, And the bank's role is really the electrical company that supplies everything right up to the outlet. And of course, that outlet is universal. You can plug basically anything into it. Then it becomes, okay, what do you want out of your utility? You want it to be dependable, reasonably priced, secure, and a bit invisible, frankly. And then you want to be able to go out and shop for all the various versions of toasters that you want to have. But when you plug the toaster in, the thing's got to work. And so I really think banking and financial services, especially the role of banks in financial services, is going to continue to evolve there to where we do take a little bit more of a utility approach to things and let consumer, dictate the appliances or the applications that they want to use to ultimately access one or more rails. And that's the bet that we're making. I think it's the bet more and more are making, is to say, I'll never keep up with the pace of products. So maybe it's an infrastructure game for me.
Interesting. And this API marketplace that you guys are, the Fintech, Opencp Fintech API marketplace, can you explain more what that is?
I think it's a pretty good example of exactly what I was just talking about. Opencp is our open API bank as a service platform. And it is really meant to provide a one-stop point or gateway to the whole payments ecosystem and all those rails I just described. And so folks come into Opencp, or companies come into Opencp, and can access any service pretty much you can imagine to facilitate a form of a payment product. What's unique about Opencp from some of the other bank as a service platforms, is really probably two things. One is embedded in all those services, those microservices that I was mentioning, there's an element of choice. And so there's multiple vendors and providers within every basic service. And so, for example, if you want to think about ID verification, we have 3 or 4 companies that we work with there. So there might be one company that's particularly good about one form of ID verification and another company that's very good about one. Maybe one's very good with low doc immigrants and the other one is very good with more established folks that have been in the country longer. And so you can begin to cascade your API calls between best in class within a specific function, or transaction processing, or all of those things. And so choice, I think, is very unique as you think about bank as a service platforms. Typically, it's not there. And then, probably for us, the biggest thing is, we like to think of it as real bank as a service because it's from a bank. A lot of the prevailing platforms out there are, access to a lot of vendors, but the actual legal entity that's got to hold the deposits, that's ultimately got to connect you into the payment rails as a financial institution, that's typically a third party. And so, we think that's a point of vulnerability. We think that's a point of differentiation for us, is the fact that the charter is effectively embedded in the platform, just like ID verification and transaction processing and, plastic manufacturing and all that kind of stuff. And so, folks that are thinking about, why do you go to bank as a service providers? It's because you really desire a one-stop shop. If it's not from a bank, I would argue it's maybe not as much of a one-stop shop as you might think it is.
Yeah. Well, that's interesting. It makes a lot of sense. So this would be a startup founder wants to create an online bank. And so they could go to you and it's just, here's what it costs and here are your options. And they say, okay, great, let's do it. And
start coding. We always joke, you can have it coded in a weekend.
Wow.
So, and that's one of the reasons why we operate a Fintech Accelerator too, because we saw the Opencp platform as a way for us to bridge that gap between bank and Fintech to do just like what you described. We have a founder who aspires to build a neobank with, some specific emphasis that you see, that's a big leap to get over to a bank and be able to operate a program on a bank. If the bank isn't well versed in fintech and the fintech isn't well versed in banking rules, we always joke that's kind of a canyon, if you will. And so, we did Opencp. We have what we call the Falls Fintech Accelerator, where we bring founders through, and it's all around this idea of us getting a little closer to them and them coming a little closer to us, to make that relationship really work in the marketplace.
I'm curious about that. I want to ask you about the accelerator. Before we get to that, what would be an average, ballpark if I was going to go and raise money for some idea? I'm a startup founder, and I go to you and I say, "Hey, I want to set up this bank." What does a bank cost to set up nowadays?
Boy, probably runs a big. There's probably a big gap there in terms of it could go from. I'll throw out a number, and then it'd be interesting to see what founders have said. But it's probably a minimum of 5, probably closer to 10 million to get you into what I'm going to call an MVP in market, testing your concept out, acquiring some customers. That's not a scalable number for sure, but to get you into market, it's probably in that 5 to 10 million range. So what we try to do in the accelerator is when they're pre-MVP or they're just about to MVP, bring them into the accelerator, help them get to market in a very small form. So that really accelerates their ability to raise funds and then sort of brings them closer to that market launch, because they can go to an investor and say, look, I've got a beta product, I've got a bank partner, I've got all those things. Now, of course, the last thing I need to really take this to market is the proper level of funding.
That would be going through you guys. If I came to Central Payments and I said, "Hey, spin me up, give me the average." Yeah, and is that, what is the majority, like pie graph of that is compliance lawyers are doing $5 million worth of work, or clearly it's not a API call and it just pops up?
I think it's the technology build of whatever your user experience has to be, and it's your staffing. And certainly compliance aspects are a big reality. Not all of those funding goes to us. In fact, most of it's really spent on building out customer acquisition and user experience. And so I would be willing to bet most of the founders would say that's where the greatest burn comes in. Now, if you don't go to a bank as a service platform and you have to put all those pieces and parts together, find a bank partner, find a processor, find a card manufacturer, et cetera, then it's going to get expensive very, very quickly. One of the main reasons we built the Accelerator plus Opencp is we found a more frictionless, it's not friction free, but the least amount of friction for a startup to get to market as we can think of, because again, you're going to get all those services embedded in our platform and not have to piece and part them together. Because if you've raised $5 or $10 million, your investors in many cases don't want you to say, the last thing they want to hear from you is like, you've built the biggest, most robust AML department to look for suspicious transactions. That's not what early stage investors want to hear. They want to hear, like, I'm coming to market, I'm in market, I'm beta testing, I'm acquiring customers, this is my cost of acquisition. It's all around growth. And so they need somebody to come in and kind of help with some of those backroom processes, if you will, and putting all the pieces and parts together, because again, they're incented to grow and create great user experience.
Yeah. And so this accelerator, you started this or through the central bank or central payments?
Yeah, it's called False Fintech, but it's a central payments accelerator, and it's a way for us to bring companies through and effectively embed them for 12 weeks. And us learn from them learn from us. What's it going to take to come to market? Here's what compliance is going to require. Here's what data security looks like. Here's all the things you need to think about, in order to do business with the bank. Here's the regulatory expectations. And then, of course, here's Opencp, code away. And so it's really an idea that when they come through the 12 weeks, they've either raised a good chunk of money, or they're right there ready to go raise it, because they've checked off a lot of the pre-launch expectations of an investor. Got a product, got my MVP, got my bank partner. I'm ready to flip the switch to start having live transactions. That gets them a lot closer to the eventual Series A or their seed that they want to do than if they didn't have any of that.
Interesting. And so you started this 2019, a couple of years ago. How many companies have gone through this program?
We bring 2 groups of 5 through every year. So we just finished our 4th group of 5. So that's 20 that we've brought through.
Those are companies?
And they're from all over the world. And so we've got companies from the last company I mentioned to you earlier. The last company that came through was from Moscow, and so it's been a great way for us to interact with the fintech community. And they'll tell you, and if you go out to our YouTube channel or any of our socials, you'll quickly see the value that they're getting out of this. And in the end, it's all around helping them. I hate to overuse the word accelerator, but for us, it really is accelerating them to market. It's taking the steep curve out of, okay, I've done all this, I've got this great idea. Now I've got to go put all these pieces and the parts together. It gets to be a very, very steep curve that I have to try to navigate. We're just about smoothing that curve out a little.
I love it. So 10 companies have gone through the program, and they're 10 per year in 2 groups of 5. That's awesome. And is the plan to keep doing it? Is this a program that you run, or what's it?
Yeah, no. And in fact, I have a co-founder of False Fintech with me, and she, we're always applications are always coming in. We get a lot of applications, and it's been wonderfully successful. I think when we started it, we said, look, these are early stage companies. If 30 or 40% of them survive, that becomes a nice channel of new business for us, to bring through. I think 17 of our 20 have survived and will survive and are coming to market with us. And so that is a performance level that we did not expect. And we think it's because they've had a lot of success raising money, because they can show they're much closer to being a real thing.
Interesting. And I imagine this is a big part of your partner's time or your time. I mean, running Accelerator is it's difficult to make that a part-time thing. Are you leaning more into it? Do you feel the Accelerator model, at least the niche that you've carved out in the banking and fintech, is this something you want to bring 50 companies through and scale it all over? Or do you feel like keeping the 5 companies every 6 months is the right cadence?
Yeah, I think what we're probably going to do is begin to look at various levels of the Accelerator participation, on site for a small number of companies like we have historically, but then pushing out various forms of curriculum and technology to more of them, so we can touch more fintechs without having, because it is very labor intensive to bring them in and spend that much time with them. And so do you begin to think about level 1, level 2, and level 3, so we at least have some interaction with a much larger number of fintechs. And that could be things we want to do around our sandbox environment, things we want to do around online curriculum, those sorts of things, so that way we can broaden the reach. And we have a small team dedicated 100% to False Fintech. They're interacting with startups and VCs every day, and they're keenly interested on the right level of expansion is, and obviously staying true to the mission of finding the companies that are very close to MVP. We like to think of it as the clay is still warm and moldable, and so they don't want to we don't want them to be too far into the process that we end up having them sort of retool their offering. We don't want to bring them backwards, but at the same time, we can't be grabbing them too prematurely when they just aren't ready to even decide what their product looks like. So there is a window there of the type of fintech that we're looking for, and fortunately, it's worked out really well for us.
And there are 12 weeks. So at the end of the 12 weeks, is there a demo day or a day where everyone?
There is. If you go out to our YouTube channel, False Fintech, and just hit YouTube, you can watch all the videos. We just had a demo day a week and a half ago. It was wonderful. We had a great time.
And obviously, the demo days are aimed at raising money for the companies for the most part. Is there a template offering, an investment? I know Techstars. I went through the Techstars program. They do $20K, takes 6%. I want to say 6-7%, something like that. I think it's also 12 weeks, and then they help you raise.
Yep. So we come up we come up under 20 in what we give. We don't take that much equity. You'll be happy to know. For us, we think the real value add is less around the financial contribution we're making to the company or the investment we're making. It's really about them being able to come back and say to the real investors, "I've got my bank partner." I mean, that's such an enormous undertaking for an early stage company to secure that when they can say, look, I'm going into false fintech, and provided I, fulfill the expectations of false fintech, I'm going to have a bank partner when that 12 weeks is over. And because I have the bank partner with an open API platform, I've got access to the whole system. I'm going to be building. And so that, in our mind, is really the value add of false fintech, is overcoming that particular hurdle.
Yeah. Is it and will it go remote, or do you feel the in-person bringing people to, because for a lot of people moving for 12 weeks to South Dakota is difficult. I'm curious the remote thoughts.
So we started False FinTech. The first cohort came 4 days before effectively the U.S. shut down because of COVID. So that first cohort came in March of 2020. And they literally were in Sioux Falls for 4 days, and then we had to send them all home. At that point, then it went 100% virtual after that. Now we've gone back into more of a semi-on-site. So of the 12 weeks, it's 2 here, and then it's back home, 2 more in the middle of the period, back home, and then 2 more at the end of the period. So you'll spend 6 of the 12 weeks on site here. And so it goes sort of a middle, like anything today post-COVID, right? It's somewhere between remote and in person.
It's interesting. Yeah, I wonder sometimes how much the in-person matters. If you can do Zoom and you can be efficient communicating remotely, especially if people are traveling from, like you said, Russia, it's difficult to make 3 trips in a couple months. So
yeah. They were fantastic. But we had a participant from Africa, Canada, which doesn't sound like a big trip, but in the middle of COVID to get from Canada to the U.S., quite an undertaking. But I think the participants will tell you they enjoy the on-site. Not so much about the weather in the middle of winter in South Dakota. That's probably not something that's very high on what they enjoy. But they will tell you that if it is the middle of winter and they're a founder and they need to be head down on their build, there is something to be said about being here in rural America in the dead of winter, because you're not distracted by the beach.
Yeah.
You're not distracted by anything else. You're just head down. And I think what they like about being here is not only do they get to spend time with all of us, but I mean, they're right here next to my compliance person and my info security person and all these people at Central Payments that they can just come over and sit in the office or go have lunch with and just sort of whiteboard with. And I mean, it's the part I enjoy most about our participants is, just getting in and brainstorming and whiteboarding with them, because they soak it all up. And so I think that access, again, going back to the value of the charter, I think the access to those people on our staff, they would say probably is the most rewarding piece of it.
That's awesome. Well, congrats on your progress there. Last thing I want to ask you about, I was just so curious, the 14 patents. So would you consider yourself more on the developer, engineer, builder side, or more on the sales and marketing side?
I think I'm more of a product person,
Okay.
to be very honest with you. I think I understand enough development to facilitate how I want a product, whatever happens to be, to work. I think it goes back to my early days, even as a bank examiner. I know you don't think bank examiners and entrepreneurs or inventors in the sort of the same thought, but when you understand the rules so well around regulation, you can really accelerate your product build, because you know right away what's going to work and what's not going to work. And so I think, as the stuff that I've been fortunate enough to secure some patents on, is really around product building more than anything else, and then bringing good developers along so they can take the vision of the product functionality and the user experience and the use case, and obviously design.
What's an example? What's an example of something I could understand that you invented or patented?
Well, I think certain ways in which you can secure repayments for loans off of funds flows that are happening in those pipes that I was talking about. That would be one example of something that's out there. I think there's two related to that. Using different rails to run different types of products that aren't normal, or maybe not what the rail was intended to do, but you can use that rail for other types of products as well.
Would this be like
is another example?
I'm thinking of I know Stripe and I think Lyft uses this ability to pay out drivers on a debit card. So like flipping debit cards. Yeah.
which is effectively, they call it an OCT in other credit transactions, but it's effectively the inverse of a normal transaction using the payment rails, right? It's issuing a credit back through the rails as though you returned a pair of shoes. That's effectively what that transaction is. It's just there's no transaction that triggered the credit. It's an original credit transaction.
Right. Which I wouldn't think of that as a major innovation, but I guess that there's such a huge market and there's so many different use cases that all of a sudden now that becomes incredibly relevant, because it doesn't take much for it to be better than everything. If it's, one day fast, ACH is such a low bar that.
Yeah, and it is. It's an incredibly low bar, even at same day ACH. I mean, we're such a just-in-time expectation around our economy and all aspects of our economy that for funds movement not to happen in near real time just doesn't make any sense to a lot of people in this space.
Yeah, fascinating. Well, congrats on all your progress, Trent. It was so interesting to hear about the Accelerator, your views on regulation, and the history of or your experience with the patents and inventions. Are you active online? I knew you mentioned the social media. I assume that's through the company.
Yeah, of course. You can follow me at it's just at T Sorbe on Twitter. I'd encourage you to follow False Fintech at False Fintech. We're also very active on LinkedIn and YouTube too. So any of those, they sort of overlap, and you'll be able to get all the experiences
Awesome.
there.
Well, thank you, Trent. Appreciated jumping on today.
Thank you, Mike. I really enjoyed it. I appreciate the
All right,
invitation.
take it easy.